So just a bit of an overview of what we're going to be discussing today. So we have Alex Maddox, our Capital Markets Director here to give a market overview and look at the impacts of Help to Buy. We'll then be giving a brief overview of our new build proposition at Kensington by Kirby, our Key Account Manager. Craig McKinlay, our new Business Sales Director, will then be talking about Kensington's approach to the post-Help to Buy world and what our plans are for 2020 and 2021. We then will do a summary, and we've got some pre-submitted questions, so thank you to those who submitted them, and any additional questions, please feel free to type in the box if you have any, and we'll do our best to answer them if we have enough time. So I shall hand over to Alex Maddox, our Capital Markets Director.
Good morning, everybody. Good morning, everybody. This is Alex Maddox. So if you look at your screens, I'm going to do 3 or 4 slides talking about the impact of Help to Buy on the housing market and just how successful it is. I'm sure everyone on the call will be very, very aware of how successful it's been, but it's always useful to see it in numbers. So if we look at the first slide, which actually is slide number 4, the top chart there shows house building starts and completions since before the financial crisis, and you can see there that if we look at the line for housing starts, quite a significant drop from actually almost 175,000 starts per annum in 2007 down to 85,000 in 2009. So pretty much a 50% drop in housing starts. And you can see that it pretty much flatlined through to the start of Help to Buy and has now increased back to almost back to where it was in 2007 at 170,000, so doubled from the lows in 2009. Housing completions, as you'd expect, weren't quite so volatile. They dropped from 170,000 down to just over 105,000 and have gradually come back and actually are pretty much at the same level now as where they were before the financial crisis. So, you know, if the goal of Help to Buy was to stimulate house building in the UK and recover it back to pre-financial crisis levels, I think the data shows that it was pretty successful. If we look at the bottom chart, this is the split of property sales in the UK by property type, and I think I'd ask you to focus here on the line that goes through this. And you can see again, we were sort of 12% of sales were new build. It's pretty interesting to see the dip in 2007, how that bounced back in 2008. But really, I think what's interesting is really the 2010 to 2014 period, where for a long time new build property sales were about just under 10% of all property sales in the UK, and then in 2018 they were up to 12.6%, and we've got some data later on in the presentation showing that they're probably even higher than this. So I'll now move forward to the next slide, to slide 5. So this is the timeline of key Help to Buy events. So the whole process really kicked off in April 2013. Interest rates in the UK have been as low as 0.5% since 2009, and the government was working hard to try to stimulate the housing market. There were a number of different property-related, quantitative easing schemes that came into the market, but certainly Help to Buy was the most successful of these. Initially, the scheme was designed to support 75,000 sales with a budget of 3.5 billion. And ask you to keep that number in your mind as we look to where it's expected to get. The scheme was extended twice in 14 and 15, and it was extended through to 2021. A key date, I think, was February 2016, where for London properties, the equity share was increased from 20% to 40%, really as a result of the larger deposits needed in London because of the property prices. And then in 2018 we saw the starting of tapering, which is the phase I think everyone uses for when quantitative easing these sort of programs start getting unwound, and so this was really I guess the key moment where the scheme is starting to reach its end. So the scheme will continue until 2023. I think interesting there, the government expects the total amount of properties that have been purchased with the scheme to reach 480,000. So that's 6.5 times the initial plan of 74,000. So the scheme has been very, very successful. And will continue to. And as you'll see later on, that 480,000 has still got quite a way to go. The scheme will be fully closed post 2023, and right now there's no new government scheme announced, which, as you see, will leave quite a gap in the market. So if we look at slide number 6, some more information here on just again how successful Help to Buy has been in relation to total new build sales. So initially it grew very, very rapidly. So within a few quarters, it accounted for 34% of all new build sales were through the Help to Buy scheme. I guess here, the value was very, very clear to both the house builders and the mortgage industry, and with a lack of product availability at higher LTVs, it caught on very quickly. It has continued to grow quite a lot. From that 34%, we're now just over 50% of all new build property sales are via Help to Buy. So has been very, very successful. I'd also draw your attention to that final bar on the right-hand side, which basically shows that the cumulative amount of Help to Buy loans have been 236,000, and you can compare that to the number we saw on the previous slide of 480,000, which is the target for the government. So still an awful lot to go if the government's estimates are correct. One thing also perhaps to mention at this point, and we'll be releasing one of our newsletters shortly from the capital markets team, we've also had a look at the market capitalization of the top 5 property developers in the UK over this period. During the period of the Help to Buy scheme, the FTSE 250 has increased by 24%. The average increase in market capitalization of the top 5 developers has been 206%. So what we've seen during this period is that the home builders have really outperformed the broader market, stock market. Now, some of this would be expected after a mortgage-related financial crisis, but I think a lot of people have been talking about that in the press. On a related note, another criticism of Help to Buy is often around some of the higher income borrowers that have taken it out, and this is shown on slide number 7. If you look at the area in the red box or the red rectangle over on the right-hand side there, you've seen 26,000, so about 10% of overall Help to Buy has been to borrowers earning £80,000 or more. I think it's easy for people to point at this, but I think the good news from the market is that the majority of Help to Buy sales have been in that sort of 30,000 to 60,000 segment, where we would expect the volume to go. Obviously, one of the key criticisms has been that this scheme has allowed people who, for instance, could have bought a 2-bedroom house to buy a 3-bedroom house. And it hasn't necessarily delivered, just a pure increase in property prices that it was needed as a result of just lower equity commitments. So I'll now turn to my final slide, which is slide number 8, which is talking about the current market status. If we look at the chart on the bottom left, as I said, Help to Buy as a percentage of all property sales, we're as high as 8% now. So when this comes out of the market, it will leave a significant gap. If we look at the bottom right-hand chart, which looks at the LTV split for new residential loans, during sort of 2009 to 2010, as I'm sure everyone on the call will remember, there was very little product out there at the 90 to 95 range of LTVs, down to below 1% of total market lending. Now that's close to 6%. Obviously, the amount of 95% plus is still very, very low. If we look at the availability of 95% LTV products, in April 2009, there were just 3 providers. Now there are 60, according to the sourcing systems, and there were just 3 products as well, and now there are 405. So a significant change in product availability at 95 LTV. And one of the key goals of Help to Buy was to provide a gap when there were very few 95 LTV products out there. Just in terms of rate, if you look at 5-year fixed rates back in 2009 and at 95 LTV, rates were just over 7% on average, now closer to 3.7%. So significant product availability improvement and market rate reduction. So obviously I think the takeaway from my slides is that the Help to Buy scheme has been very successful. It really has delivered the increase in home building that the government was looking for, and the market has improved in terms of availability of alternative mortgage product, but at the same time we still expect there to be a significant gap left as the Help to Buy scheme comes to its natural end in 2023. So with that, I will hand over to Chris Kirby, who will take you through the next section of the presentation.
Thank you, Alex. So what I want to do in the moments that I've got with yourselves is just give you a bit of a background to Kensington's new build proposition, but also the journey that we've been on in relation to proposition evolution, just to give you an idea as well of the importance of Help to Buy to Kensington as a lender, and obviously the importance of then looking at alternatives for that as well. So as I mentioned, the sort of journey with Kensington, so to speak. So we joined the Help to Buy market in 2017, and then since then we've constantly been, based on broker feedback and sort of market conditions, been evolving our proposition. So in May 2018, we increased our loan to value for those that were looking at alternatives to Help to Buy. I think, as Alex mentioned, a lot of people have maybe utilised Help to Buy when it wasn't necessary to facilitate their purchase. So we increased our loan to values on houses and flats to 90%, and that's up to £1 million as well. And then in October 2018, we set up a new build underwriting team. I think it's sort of just demonstrates our commitment to that area of the market, to actually have an underwriting team fully understanding of the needs of that market, the needs of brokers, the needs of developers and clients. Valuations instructed on day one, and what we've also done as well to help brokers is we have a 6-month offer on all new purchases that can be extended on your new builds by a further 6 months, so there isn't that need to resubmit the same cases over and over again if we can just extend those. My role was created, so I was hired as the new build key account manager. So my role is focusing on key new build specialists in that market and supporting them, allowing them to help their developers as well, to provide the best service through the utilisation of ourselves as a lender. And then in June 2019, we joined Help to Buy Scotland. We cover the whole of mainland Scotland, which is a real positive for us as well. And it's been a success since we've been up there, and hopefully that will continue. And then in October 2019, we again reviewed our new build underwriting process. So the new build underwriting team had been in place for a year. So off the back of that, we increased the number of acceptable warranties that we will now take, which again opens up to supporting more developers and more brokers, as well as the relaxation of our reinspection policy within 6 months of the valuation. And then only a few weeks ago, in November 2019, we held our first new build forum. So really good engagement from developers, networks, brokers, etc. Really just looking at ways that we can continue to add value to the new build market with all the changes that are going on in the Help to Buy market. And that sort of leads us on to just giving you an idea of how important the new build market is to Kensington. So prior to joining Help to Buy, we did £38 million worth of new build business. That was about 5% of all of our completions. Obviously, you can see then we did join the Help to Buy scheme. Safe to say a bit of a slow uptake at first, but what you can really see from 2018 to 2019 is how our new build proposition, as it evolved, it accelerate the business that we were doing, and similar to what Alex mentioned in relation to the proportion of new build completions that are using Help to Buy. So we were doing £87 million worth of Help to Buy business of a new build completion book of 168 million. We've had again a really good strong year. So calendar year we've seen a real big increase in our new build volumes, and the financial year we're projecting we could get as much as £250 million worth of new build business, of which we're expecting or forecasting just under 150 million pounds of that to be Help to Buy. So around about 59% of the new build business that we're doing is Help to Buy. New build does equate to 15% of our business. So what's really, really important is the reason we're having these meetings, these webinars now, is to make sure that with their changes to Help to Buy, we still want to be committed to that new build market. We still want to add value, and ultimately it's making sure that we've got plenty of solutions over the next couple of years and in a market that is post Help to Buy as well. So as you can see, very committed to the new build market, and hopefully that will continue. So what I'm now going to do is hand you over to Craig, our new business director, who will talk you through our approach to the post Help to Buy world.
Thank you, Chris. Good morning, everybody. So start off by just explaining how we've tried to approach this problem. It's a problem I know all you are struggling with, and everybody's wondering what's coming next after Help to Buy. So we're very keen to try and drive that forward and coalesce around an industry solution. So the first thing we did is we had our New Build Innovation Forum at the end of November. So thank you very much for those of you on the phone who attended. I know quite a few of you on the phone did attend. So that was a really useful session. It's very keen to find an industry solution to what's effectively a market problem. It's really good attendance, really good to have attendance from two of the biggest builders. We had most of the main brokerages and new build intermediary players in the room. We had Robert Sinclair, so we got a really good view from what do builders need, what does brokers need, and obviously from a lender we can take that perspective to try and build a solution. And we went through various solutions, looked at the pros and cons, and we committed to coming back to those attendees and to the rest of you to talk about kind of what we've learned and what we plan to do with it, which is why we're here today. So in terms of the various options, really falls down into, there's three kind of buckets of opportunity. There's private Help to Buy, high LTV lending, and shared ownership. So what I'll do is I'll go through each of those three areas and talk about the pros and cons, and then I'll finish off by just talking about what Kensington are planning to do. So in terms of private Help to Buy, so this is effectively replicating the Help to Buy. So it would be a private business taking that second charge, shared equity loan, interest only. There's only really one person that I'm aware of in the business, in the industry, who started to do something like this, which is Propertunity. So they're doing it in a fairly small scale way in just a few postcodes in London. But hopefully there'll be other people who are interested in this. So in terms of some of the benefits of this, it's good affordability compared to traditional mortgages, because the second charge tends to help with that. You've got a lower barrier of deposit similar to Help to Buy, because the customer's only having to put 5% in. Lower monthly costs, because you tend to look at a blended mortgage rate, so it tends to be cheaper than a high LTV mortgage rate, so it's better for the customer. And it's fairly comparable, so I think Help to Buy is very well understood by the industry, and this is a replacement that looks very similar, so I think it's pretty easy for people to understand. Some of the negatives, same as Help to Buy, the customer does share the equity, so if there is house price growth, they will have to share that with the shared equity owner. There is no interest-free period on the equity loan, which is different to the Help to Buy scheme. Probably the biggest challenge at the moment is Help to Buy is pretty much universal, whereas any single provider is unlikely to have that kind of breadth and depth of distribution that Help to Buy's got. So you may find, like Propertunity, they're only operating with a limited amount of funding in certain geographies to certain customer types. So there may be lots of different providers for this, which adds a bit of complexity. And then in terms of versus a traditional mortgage, so a 95% lending, it is more complex, as is Help to Buy, because the customer has two loans. So I think the opportunity for this will be very much dependent on provider appetite. So lenders of this second charge, who there are very few of at the moment, but hopefully that will change. So in terms of shared ownership, obviously everyone's very aware of what shared ownership is, so I won't go through that. In terms of the pluses, you've got the affordability benefit. There's no stress on the rental payments. So affordability is better than a traditional mortgage. So you're by virtue of that, you're increasing the population of people who can use this. Very low deposit because you've got a lower share, so you can have a deposit from just a few £1,000s because you're doing 95% lending off a share of the price. It's a very well established market, 27 lenders already in the market. It's been around for 40 years, so this is well understood. And what we're seeing is there's some really good innovative private sector style solutions coming to market. So people like Halo, which is really broadening out the appeal from what's traditionally been a fairly small scheme with very specific housing association suppliers. So that's really interesting. In terms of some of the negatives, customers do need to be educated. It's not that well understood shared ownership. There is a bit of a tag of kind of, I wouldn't really say subprime, but I don't think shared ownership is seen as aspirational as owning your own home. Traditionally, it's quite a limited scheme, so it'll be a few plots on a development, so it's quite hard to find those plots, and it does tend to be in a corner of a development. And restricted properties. It does rely on government and housing association funding, which may be limited and typically is operated in pockets. So that needs kind of widespread funding. The government is committed, the new government's committed to doing a lot more shared ownership. So hopefully that's good news. Again, similar to shared equity, the customer shares the equity in any increase in house price growth. And then yeah, more complex for lenders, clearly. If a lender needs to repossess and dispose, you've often got housing association rules around how that property gets sold. But feels like a big opportunity. It's already about £3 billion, so this is a mature product and in a mature market. And I think with things like Halo coming into the market, you could see how this could really turbocharge and become, not necessarily the solution to Help to Buy, but I think one of the several solutions to Help to Buy. And in terms of high LTV lending, so there's a few different ways I've looked at this, which we'll go through. So the most simple is just for lenders to start doing 95% lending without any risk mitigation. So very, very simple. It's 95 LTV like you can get for like there's many providers for, but most providers won't do 95% LTV on new build properties or flats. There is actually only 2 providers who do that. So positives are customer retains all the equity, and it's really simple. It's the only possible solution where there is only one stakeholder because it's purely one lender, whereas everything else has 2 or 3 different parties. So really simple. Downsides are very poor lender provision. Lender risk appetite we expect to be far more limited, which you can see as it is now. I'm just not sure how many lenders will get themselves comfortable for 95 LTV on new build, and especially flats, which has always been a challenge. I mean, I think even at 90 LTV on flats, there's only a few lenders like Kensington who will do that at the moment, and that's at 90. Affordability is more challenging than Help to Buy or shared ownership, and rates are typically quite high. So another way of doing high LTV lending, there's some different models in the market. So there's potentially a new solution, although there'll be other versions of the same ilk, which is market mortgage. This is the customer takes out a 95% loan, but then the lender, such as ourselves, would have another lender that sits behind us that would potentially take a 10% slice, which is great because it means from a lender like Kensington's perspective, we're only doing an 85% loan. So you would have further provision. You'd expect more lenders to get comfortable with that than the 95% new build loan, which means you'd broaden out the amount of people that are doing 95% lending at the moment. The 2 providers, you'd expect that to grow substantially, which means potentially you're bringing in new lenders. So you've got more specialist lenders, for instance, coming into the market, which really broadens the options for customers. Some of the downsides, like I say, this is quite a new idea. It's a new product, so there's very limited providers in the market. There is additional complexity for lenders to manage because you have to have someone to sit behind, and you have to set up various things like SPVs to manage the second loan. So yeah, a bit more complexity to administer. An opportunity there, probably about £1 billion, we think possibly this year, so quite small. But could be much bigger, but we basically need that product to mature and to get more lender appetite on both sides of the lending equation. And then the final high LTV, so the final way we'd get 95% new build, much more widespread for consumers and builders, would be to look at mortgage indemnity guarantees. So there is a couple of these in the market already. So this is an existing product. And some of them are talking that they'll go up to 98% LTV on new build, which should be, an expansion from where we are today. So that would give customers some really attractive options and potentially give the lenders a lot of coverage all the way down to 60% potentially. So gives a good solution potentially for customers and builders. The kind of solution that's on the table at the moment is the builder would actually put some cash in, which would give the lender some comfort. So it's not the lender necessarily putting the money in, it's the builder. No lender currently goes above 95, so that 98% would be an expansion of appetite. And there's no additional cost to lenders. And potentially for us at the application point, it becomes very simple because you treat it the same as a standard application. Downside, it does need more mainstream lenders and builders involved in this. So there is a couple of lenders who do this currently, but there's no big mainstream lenders, so that would need some big people on board. Probably the biggest challenge, and certainly from the Kensington perspective, the biggest challenge we'd have is that previous versions of this in the credit crunch and the last house price crash, we did see some of these schemes become insolvent, especially in the US, and actually the indemnity guarantee, which is basically an insurance policy, didn't pay out. So there's still a big concern there that will we see history repeat itself if you need to call on that guarantee. The builders do need to continue to contribute cash up front, so clearly that's worse for builders than the current scheme where they don't need to put anything in. And then, although it's fairly simple at the application stage for lenders, there is more complexity because you have to administer the guarantee, and then you need a kind of claims process. So that's the kind of third option of higher LTV lending. So they're effectively the solutions we see in the market that we are kind of investigating. So in terms of our plans for this year and how we intend to treat that, I think what's clear is there is going to be no big solution. There's not going to be one silver bullet that replaces Help to Buy. And whatever we come up with will not be as good as Help to Buy because no scheme, it was designed as the perfect scheme and it's been incredibly successful. And every other scheme will potentially affect affordability or mean someone has to put some extra money in somewhere or take some more risk. So I think we're probably looking at a range of options. So the things that Kensington are investigating, we are looking at private shared equity, so working with somebody to take that second charge shared equity, or potentially even doing it ourselves if potentially we could sell that loan on to someone else. So that's an area of interest. Shared ownership and Halo we are quite keen on. It's not something we do currently, but it's something we're very keen to look at. Certainly in the second half of the year, we'd like to get to market ideally. And we are looking at high LTV lending. Not that keen on the mortgage indemnity guarantee scheme, but some of the other solutions where potentially someone takes a slice of that top, maybe 10% of the lending could be quite attractive to us. So we're in active conversations there. So very keen to formulate a solution in the next 6 to 9 months. We'd like to get things into market really for the end of this year. So we want to get ahead of the Help to Buy scheme getting shrunk at the start of next year. So we get ahead of that, even though the scheme will be around for a couple of years more. We think it will be severely compressed by the changes that come in Q1 next year. So we're keen to work with all you guys on the phone to further develop these options, to look at pilots, look at trials, to get some feedback about where you think it can go. And then in terms of the things that underlie that, we'll continue to work on our technology digitization for the front and back book and systems. So we've put a whole load of robotics in so we can really digitize everything in the back office. So things like solicitors checks, underwriting checks, so we can speed up our app to offer, making everything really simple for customers and brokers at the front end to ask for less documentation. So bank statements we don't often ask for these days, and digitizing everything through things like Tech mortgage apply. So we'll continue to do that. That will give us the continued benefit in application to offer. We're very understanding of the need for fast service and certainty, especially on new build. So we managed to half our app to offer pretty much in 2019 versus 2018. We're currently about 14 days. We've got some really efficient brokers where we're less than 10 days, and we're very keen to continue that journey. We want to get down to 5 days in the next 12 months, and we've got a long-term plan to get us ideally down to 1 day. So we're very much understand how important that service is to you guys. So that's kind of our approach. In terms of, we did have a couple of questions pre-submitted. Thank you for the pre-submission of questions. So Francis, I'll hand over to you to ask the questions.
Thank you very much. So Craig, I'll be directing these questions back at you, if that's okay. So again, thanks to everyone for pre-submitting. We've spoken about a lot of different options today, one of which we didn't talk about was the bank of mum and dad. What is Kensington's stance on this?
Okay, thank you, and thank you for the submission of the question. So I think it's really good. There's been some really good progress on this in the last few years. I mean, you had the Barclays solution was out a few years ago. Lloyd's went into a big solution as well last year, all quite similar, taking a charge on the parent's house. There's things like joint borrower sole proprietor, which I think are all good and things that we're keen to look at as well in Kensington. I think we haven't focused on that today because I was keen to look at things which have the broadest appeal. It is still relatively niche. You do need to have parents who have got a low loan to value and lots of equity that you can call on, and parents who are willing to do that. So I do think it's a relatively niche, and I think it's expanding, which is why we're keen to look at it in Kensington. But it's not something I think is one of the core solutions, and we've tried to focus on the things that we think have the broadest appeal, such as expanding shared ownership, looking at high LTV lending, and potential private shared equity.
So the next question is around service. We know that service for a lender is paramount and very important for brokers. Do you think that service will change or suffer as a result of Help to Buy finishing?
I think it's a very real risk. I think if the market is flooded with new solutions, new propositions, there'll be an adjustment period. There certainly was with Help to Buy, both when brokers started using it, when the government started lending on it, and when lenders started lending on it. So I would expect a bit of kind of growing pains as we potentially have a bit of a cliff edge, and hopefully there's a flood of new solutions in the market. So I do think that's definitely a risk. It's why we are very keen to kind of get ahead of it now, and why we're trying to have forums such as this so we can try and land on a solution and get it into the market, so we can make sure that it's a mature product that people understand. The underwriting's all sorted. We know all the kind of sales process inside out, because like I say, we are keen to get that. We are keen to get down to a 5-day app to offer in the fairly near term, and what we don't want to do is this to push back out. So I think it's definitely a real risk that we're very aware of, which is where we are trying to come up with a solution now.
You, Craig. And the last question, a lot of products come to market and are not fit for purpose, which I think we all could agree we've seen that happen in the past. How do Kensington intend to get this right with some of the options that we're talking about today?
Well, I think very much it's kicking off the session we had in November, so getting some really good industry experts and engagement. It's today's session about where we've kind of feeding back what we've found, and the key thing is the continued engagement hopefully we'll get with all the stakeholders we've got on the webinar today, to really understand. This has been really helpful for us, so I'd thank everyone for their time and attention and engagement to date, so that we can come up with the next level of solution, because we want to share that with you. What we want to do is we want to pilot some things, things. We want to be very open with the stakeholders and the brokers and the builders to make sure we have a good product that's not going to fall over, that has a really slick underwriting service proposition wrapped around it, with a really good sales process, so that we absolutely don't just kind of get caught out, launch something it's kind of half baked and falls over. So very, very committed to making sure that we get that right, which is why we're trying to do this, you know, a kind of a year out.
Thank you very much, Craig. And that comes to the end of the webinar today. So thank you everyone so much for attending. We will be sharing a link to this webinar and the recording that you are more than welcome to share with your colleagues, and we'd encourage you to do so. We had requests from people who are potentially not on the phone to have it shared, so we'll put some links on social media as well. Thank you once again everyone for joining us, and we hope to see you soon.